So I'll be the first to admit, I think as both an investor and consumer, I've naturally stayed away from food delivery / ride-hailing platforms. Firstly, because I don't really see much utility or value addedness in terms of their services, other than very specific circumstances. And secondly, from an investor lens, I can't necessarily appreciate their business model, their economic mode, and what really dictates or makes them special compared to their competitors because of the low switching costs, the constant comparison, price war, so on and so forth. But that said, I think in today's video, as the title will probably already suggest, I am building up my position into this Chinese food delivery application called Meituan. And my view of this entire industry has had a 180-degree switch in my recent trip to China back in 2024. And I do believe that these Chinese monsters are operating at a whole different level. And that's why I decided to further investigate into Meituan as a company. And I've since built a 6% exposure. So let's start off with what is Meituan. And if this is the first time you're hearing of this company, let me try to explain. I think you can think of Meituan as China's life in 30 minutes button. It's basically a super app, and when you open the app, you can order dinner, you can book a massage, you can reserve flight or hotel bookings, buy pain relief tablets from your local pharmacy, grab groceries for the week, and so on and so forth. But their main foothold is still in the food delivery market, and they're very aggressively expanding and penetrating into all these different adjacent markets. So right now, they link more than 800 million customers in China to millions of neighborhood merchants, and then they pay their own army of couriers to move things around. So for those in the US, you can actually picture them as some sort of a DoorDash, which is their food delivery platform, plus Yelp, which is a community review platform, plus Booking.com, which is for travel, Instacart for groceries, and Groupon for discount tickets, all into one app itself. And this is the interface of Meituan back in 2021. They are very easily recognized with this classic yellow color. And you can see just jumping into the homepage itself, everything is just one click of a button away. And you can basically get by the Chinese urban life just with this one app itself. So the next question is, how does Meituan actually make money? They extracted the full year financial statements of 2024. And here's the breakdown of their revenue. So they have four main arms: delivery services, commissions, online marketing services, and other services. And for the first line item under delivery services, these are basically payments for the riders who make the delivery. I think they can mainly come from two sources of income. So one is either paid for by the users themselves, or the merchants can subsidize the delivery fees to drive certain sales numbers. And sometimes even Meituan, the marketplace platform itself, might also come in with certain subsidies. So to the second part on commissions, it's basically Meituan getting a small cut or small percentage for every single orders being transacted on the platform itself. And moving on to the online marketing services, they are basically advertising slots. For Meituan, you can think of them as a traffic aggregator, and for customers with very high intent of purchasing or consuming something. So merchants very easily and very willingly bid for top spots and to run their flash sales to make sure that they get the attention of the consumer itself. And on your other services, you have your new bets in groceries, bike rental, power bank rentals, so on and so forth. So just by looking at their breakdown in revenue, clearly, I think for both the commissions and the online marketing services arm, they're the higher quality one with greater amount of margin. But just looking overall at how the business is executing thus far, their operating margin for the full year of 2024 is sitting at a healthy 10.9%. And this is operating profit, by the way, not EBITDA or whatever those fluffy numbers are. And if you do draw some comparisons with their US counterparts, for example, Uber or DoorDash, they are nowhere near producing this kind of numbers. So that's why I say it's really a very interesting business model. And I'll talk more about what makes Meituan so much more special compared to the likes of Uber, Grab, DoorDash. And while we are all trying to figure out whether this whole AI boom is the real deal or just a bubble waiting to pop, why not actually put the AI to work for you without paying a single cent? So this video is sponsored by Longbridge, a MAS licensed broker in Singapore that's integrated a really powerful tool called Pod AI, built specifically for investors. So Pod AI helps you break down company announcements, summarize financial reports, and even lets you chat with it to dive deeper into any stock, from key metrics to valuation insights. So it's like having a research analyst, but way faster and available 24/7. And right now, Longbridge is running an exclusive promotion for new users in Singapore. you'll get lifetime commission-free trading for US, Hong Kong, and Singapore stocks. And if you deposit just 2,000 Singapore dollars, you'll receive a 0 platform fee coupon and a 6% per annum interest boost for 90 days. Even better, at the base tier, if you maintain your funds for 30 days and complete 3 buy trades, you'll be rewarded with half an Nvidia share. And the best part, if you sign up using my link below and deposit that same initial sum of 2,000 Singapore dollars, you'll unlock an exclusive $18 cash coupon plus an additional 6% per annum interest boost. And this brings the total to a 12% per annum interest boost for 90 days. So altogether, you could be looking at up to $160 in sign-up rewards just for getting started. So check out the full details in the description below, and thank you Longbridge for sponsoring this video. And the easiest way to provide you with more context and appreciation of how Meituan has grown is to look at the past decade of growth. And in terms of their revenue top line, you can see that it's a very nice uptrend. And like many great compounders and specifically tech companies, you can see that their revenue tend to all move in this very nice upward trajectory. But also to give you a bit of flavor in terms of their earnings, actually Meituan only turned EBIT profitable in Q2 of 2023. And you're probably wondering as an investor, at current all-time high revenues and EBIT and margins also, how would the stock price has performed? And contrary to popular belief, or at least it's nothing surprising anyway because it's a Chinese tech company, Meituan is actually still roughly 70% down from its all-time highs. But I think just to give you a bit of appreciation in terms of how the price have moved, so do pardon my very lousy Photoshop skills, but Meituan really peaked in terms of valuations back in 2021, where Meituan was kind of at the stage of trying to inch towards profitability. But I think just looking at the price chart, comparing it to their revenue and EBIT, doesn't really mean much. Let's try to dive deeper into Meituan today. So I think Meituan's business is a classic two-sided marketplace network. It's self-reinforcing and it basically connects customers with the merchant providers. So they definitely have some sort of a first-mover advantage in creating this positive flywheel. Because since everyone is already on Meituan's platform, it then attracts more diners, and the more diners attract more restaurants, which then attracts more diners, which is this so-called positive flywheel effect. And especially in the food delivery paradigm, there's also a third marketplace, which is the delivery network, the network of delivery riders or couriers. And if they can attract more riders, it means that it will probably result in a cheaper and faster delivery than any newcomers that try to come in and copy whatever Meituan has created without burning cash and subsidizing upfront. And we'll talk more about this whole competitive landscape in the later part of this video. I know it's also a very big concern for existing or prospective investors. Now, on the topic of this whole flywheel idea, we definitely cannot forget the amount of data that they're collecting with billions of all these location-stamped and geo-targeted orders, and just these preferences of these hundreds of millions of users that allows them to train the algo, set prices, map effective and efficient routes, and also to sell ads better than any of their rivals out there. And the final cherry on the cake is that Meituan is moving towards trying to trap the merchants and users via their ongoing coupons, memberships, software and hardware offer like point-of-sale systems, loans and money management tools, etc., etc., thereby increasing many of the switching costs, both from a consumer front and also the merchants that are deeply entrenched in the entire Meituan ecosystem. So just to understand a little bit more about Meituan's history, Meituan is actually founded in 2010 and they entered the food delivery business in 2013. 2015, they merged with this company called Dianping, and for one moment, they were called Meituan Dianping, and thereafter they changed back to Meituan. Their food delivery business really started to take off in 2017-2018 era. So Wang Xing, which is Meituan's founder, this is actually his third rodeo into entrepreneurship. And Meituan as an idea basically started off as a Groupon knockoff. They're basically trying to help restaurants and cinemas fill seats with group coupons. And the game-changing move actually came in 2015 when they finally merged with Dianping. And Alibaba was also in the bid for this too because they also have some sort of a food delivery platform called Ele.me. But long story short, I think Meituan, which is backed by Tencent, really won this entire food delivery business with the integration of Dianping, which is very much like China's Yelp review and lifestyle search platform. And also just some context, I think back then in the early 2010s, The state of review platforms in China were absolutely garbage or abysmal, with loads of scams, crazy amount of trying to game the system. And some of you might be thinking, what about the Google review of China? And back then, I think Baidu was still one of the big tech giants with their strong foothold in maps. Baidu basically completely ignored the integrity of their reviews and allowed for many people to game the system, which makes it very untrustworthy. With this current state of affairs, Dianping really managed to carve out a niche and being very intentional in terms of aggregating these reviews. But also, like anything in life, there are always trade-offs. With them being intentional means that they are moving at a very slow speed. But with these two very different philosophy, it actually marries very well after the merger. And it allowed for a full customer journey just in one app. From search to review to coupon to order to delivery to in-store redemption. And then now they have basically everything under one house. So which begs the question, what really is Meituan's economic mode? What makes them special? What's their switching cost in this case? So what's really stopping a competitor from copying Meituan from head to toe? So let's go back to our three marketplace analogy. So let's look at it first from a consumer's perspective. And I do believe that you can appreciate it yourself because you're probably also a consumer of these kind of platforms. So then the natural question is, why wouldn't a consumer do price comparisons or just switch away to another platform? Actually, the matter of fact is, you can very easily switch because all you are doing is that you're just one app away. You just have to download a competitor's app, go into the app itself and just start consuming or browsing. And that's where Meituan just loses this customer's eyeball and clicks. And from that perspective, actually the customer network is the lowest barrier to entry. And you can easily compare prices and you can easily switch to different platforms. But there is a very important piece here, which is the quality of the services being rendered. And really, I think for food delivery or for courier services, there are two things mainly in top of mind for consumers concerned. Firstly, of course, it's delivery speed. And secondly, it's the breadth or network of merchants that you have. So I think for now, I think Meituan sits very comfortably at the top seat with their current network of merchants and just their top of mind recall to everything urban delivery related. And to kind of lock in the customers in this case, they then also recently launched just a few quarters back this idea of a membership where they have some sort of a special offer, whether is it cheaper delivery services, extra coupons, flash sales, so on and so forth. And of course, this constant habitual learning of behavioral patterns, which to some of you, you might think that it's a bit of a woo-woo, because I think for the majority of consumers, a lot of people are price sensitive. So if a platform today comes out with the exact same offer and they offer it at a cheaper price, you more likely than not will switch over, unless maybe you're locked in by memberships. But I think one really underrated weapon for Meituan is really the review system, which is why I said earlier in the slides that it's a game-changing acquisition between Meituan and Dianping. And this review system, up until today, is still one of the most trusted and well-liked amongst the Chinese consumers today. And through my visits and talking to the locals there, no one comes close. Not even A-Maps from Alibaba or Ele.me or Baidu, whoever there is. Meituan's internal review system, it's still number one easily. And now, moving on to the second perspective, coming from the merchant's point of view. So why won't they switch away? Actually, if you think about it, they very well could. Because from their point of view, they're just managing an extra platform. Maybe there are registration fees, some sort of an upkeeping fees, but from their perspective, if you think of it from a business owner point of view, more leads just means more sales and down the line more profits. So why not? I don't necessarily lose much unless it's a very high upkeep cost. But I think one very underrated fact, at least for those of you who don't know how Meituan operate in China today, is that a lot of all these merchants, they care a lot about the traffic Meituan brings in. And they will penalize or hurt merchants if their utilization is weak. So in a way, let's think about it. Let's try to role play a restaurant owner mindset today. So I do offline sales, which is where customers just walk in. And I do online, which is the food delivery platforms. And today I have Meituan, I have JD, I have Ele.me. Yes, fine and dandy. To me, all I have to manage is just upkeep costs. But they know that out of all these food delivery platforms, Meituan still bring in the most number of sales. And it's not even funny. It's in the 70-30 or 80-20 rule. So if Meituan is really working well, what will you be thinking? I think you can think one of two ways. Number one, you either double down, you start to run ads, you start to use Meituan's platform more, or number two, you start to diversify the platforms because you don't want to rely on just one platform alone. But regardless of which action you take, Meituan actually still wins. Because for the first course of action, you are spending more money, you are allowing for more advertising revenue, and you are just locking yourself deeper into the Meituan ecosystem. But on the other hand, if you decide to take the second course of action, which is to start to diversify, then Meituan will start to penalize you because your utilization or your turnover on the Meituan app platform itself is weaker than your competitors, and they might start to push your competitors up instead. So in this case, you think about it. Would you want to kill a golden goose just to have more other gooses laying normal eggs? Or do you want to double down on the golden goose that's going to hatch more golden eggs? And really, you can say that it's unfair competition, but Meituan is just flexing their muscles. It's a free marketplace. You can do whatever you want. I have no intentions of trying to lock you in or forcing you to only use one platform, but it's just the structure of this competition and how Meituan really create this internal ranking system that really makes merchants love and hate them at the same time. And I think through a few conversations that I had with many of these restaurant owners, operators that have chain restaurants, they're really grabbed by the balls. And of course, let's not forget that Meituan as an ad platform, they also have back-end analytics. They allow you to do heat maps, data analysis, a lot of all these consumer preferences, which part of your menu has very high repeat orders, so on and so forth. And the building of the ad architecture on the back end, and also ensuring a very healthy level of ROI on their ad spend. So comparatively, when looking at the customer and merchant journey, I think the customers have a much lower barrier to entry, but the merchants, they are pretty much locked in this case. And lastly, looking at the riders, let's ask ourselves, why won't they switch away? So actually, they also very well could, especially when rival platforms or new entrants offer huge incentive and subsidy, which is what we are currently seeing. But I think they are much more concerned about order density, which goes back to traffic again. Because if you have a lot of people ordering and the demand is able to match supply effectively, that means that the delivery riders can achieve more trips per hour, also meaning or translating to higher effective wage, predictable earning scheme, and also not forgetting that a lot of all these platforms have their own incentive structure to also lock in the riders. And to sum it all up, I think more users means more orders, means denser routes, means faster and cheaper delivery, higher earnings, more merchants, better review ROI, bringing in more users again. So if you break any of this one link, I think the whole loop actually weakens. But for Meituan today, I think they currently lead on every note, and they're leading by miles ahead. So let's pivot our attention to the talk of the town, which is this recent foray of JD going all in into the food delivery space. I'm saying that JD.com's founder actually vowed to speed on overseas foray and to compete with Meituan in new arenas from food delivery to travel. And he did cite that the past half decade, which is the last 5 years, was the darkest period for JD.com, and the company lost its way. He pledged that JD's future growth should all be about leveraging a better-tested logistics network in areas like meal delivery, where it's making headways despite initial losses. So actually after this announcement or development, Meituan's share price actually took a pretty big dive, because regardless of whether JD.com has lost its way, it's still considered one of the bigger tech companies with deep pockets, and they have a very healthy balance sheet. So if they go into an all-out war with Meituan into this food delivery arena, I think none of them will win. Maybe at the end of the day, consumers or even delivery riders will win, but the two main platform companies wouldn't win, because all they're doing is subsidizing, trying to bring in incentive, doing marketing, so on and so forth. So for myself, I seriously don't know how this competition will turn out. But I think the fact of the matter is, one company has executed superbly in the last 5-10 years, while the other has faltered the last half decade in his own domain of e-commerce. But I think one very important caveat here is that there's this Chinese idiom called 狗急跳墙, and I think a very direct translation is that when a dog is desperate, it can even jump walls. So in a way, I think you can really look at JD.com as they really have nothing much to lose now. The main business isn't really doing very well. They are losing market share. They have actually built up a very strong delivery network, but there's not much innovations going on there as well, and they're opening up to their competitors. And right now, it just seems like they're diving straight into this food delivery industry, hoping to try to strike out something of their own. And I also do draw comfort in past execution track record, the established flywheel that is spinning very rapidly, entrenching Meituan's business, and also the low margin nature of the food delivery industry itself. Because I think at the end of the day as investors, there is still a need for sustainability of the growth strategy. And for JD.com going head in, even though Alibaba has failed in trying to dethrone Meituan. I do think that there will come a point in time that JD will realize that they're unable to compete as well and then probably exit the industry. So I'm actually quite bearish of JD's entry into this business, and that's why I'm happily just accumulating and acquiring more Meituan exposure, especially when the market is very afraid of them coming in to compete away profits. And in this case, I think the natural outcome would be a lose-lose, but JD will be losing a lot more and they will not be able to sustain their growth strategy. Also, I think we must talk about the risk to the downside, and I actually did rank many of these concerns about Meituan's business from most important to least important. So firstly, of course, we have very aggressive rivals from all sides, coming up with also new ways to penetrate. So Alibaba's Ele.me has already taken a backstage with currently a 70-30 split in market share. ByteDance, surprisingly, which is the parent company of TikTok, they are kind of trying to monetize the huge amount of attention that they have on their platform. So they're not necessarily going to food delivery, but they are equipping a lot of their so-called influencers, trying to get them to do some sort of a social commerce network for food in and of itself. So they're not targeting the food delivery, but they do have presence in terms of trying to convert their users to food orders. So from that perspective, they're really just creating a new market. And lastly, of course, we have JD.com, which is their new foray and their will to fight, to subsidize and to also tussle it out with Meituan. I think this currently is the largest narrative at play here. Also, we have a few other risk factors that include the regulation and labor laws, like raising costs, social security, rider incentive. So this is a lot more of a policy concern, where what the regulators would think of Meituan. And also, you have the consumer slowdown, a weak economy, most people are cutting back on their discretionary spending. But I think if you have already sat through the last 5 years, I think it has already one of the bleakest moments of recent China's history, unless you think that it will go from bad to worse. If not, I do think that there's some sort of a bottoming in terms of consumer sentiments and spending. And lastly, I think we have the execution risks abroad, especially their overseas push into their Kita platform in Saudi Arabia. You might or might not see a good ROI. I think things are still quite early to tell. But if it's really in terms of execution point of view, Meituan has had one of the strongest track record in terms of competing in a very cutthroat industry. So just one very side point is that actually the general sentiments of Meituan in China is that they have been one that squeezes everyone's balls, whether is it from the riders to the merchants. And the ultimate winner is of course the platform itself and the end consumer, which is the users. They don't necessarily have a very good reputation in terms of taking care of their riders or merchants. And like I said, a lot of them do have a kind of a love-hate relationship with the platform. But to me, I think as an investor, I don't necessarily see it as a red flag, but more so it necessitates and it draws out the importance and the emphasis of the mode of the company, which is if you don't like the company and you're still using it, there is a certain magic to it. And also a side point, which is also a counter to what they call 剥削. They are basically, I don't necessarily know how to translate this effectively, but sacrificing the merchants or sacrificing the riders so that the end users get a better experience. Both good and bad, but I think one important thing that you need to remember as well is that I think in a very weak economic environment, Meituan is also one of the largest employer because they really do drive a lot of demand and they need these gig workers to go into the economy to help out, whether is it to tide through certain unemployment periods or really just to make a living. And I think comparatively, there are quite a bunch of people that prefer to be food delivery riders compared to working in construction or in farming, so on and so forth. So that's just some perspective as well. Now, when you look at Meituan's valuations today, I think just to put out some disclaimers first. So in their latest quarterly report, the management actually did warn investors they're not backing from the fight with JD. So growth and margins will probably take a hit in the subsequent few quarters. And Meituan is still very much like a growth company with I think 12, 15, 20% growth year on year expected. And their bottom line margins, whether is it from an earnings or cash flow perspective, might not necessarily be optimized, which even though they're sitting already at like 10.9% operating margins, which I do think that it's quite high, especially in this food delivery space. So I think it's hard to kind of pinpoint or project their terminal value because all of this is guesstimates and I don't really know what proper margins to use. And I think looking at Meituan's end valuation, it really depends on your overarching thesis of the business. So I've actually made a previous episode talking about the so-called end game of Meituan, which is going to be the toll booth where they just do a take rate of all urban transactions in China. and not just scoped into the food delivery business. And if they can execute towards this vision, then I think the business will be a lot bigger and stronger in time to come. So when looking at Meituan today, specifically the valuation, I do take more of a relative valuation approach rather than absolute, which is to try to kind of project out their future earnings or free cash flow and then discount it back. But I think looking at it relatively speaking, looking at this top 3 matrix when kind of observing some sort of all these growth companies, you look at forward PE, you look at price to gross profit, you look at price to operating cash flow. To me, I don't think that they seem quote unquote expensive to pay up for Meituan's current business quality and their growth prospects ahead. Price to operating cash flow of 12 times, forward PE of 18 times. If you're expected to grow 15-18%, that's a pack of 1, and a cash flow yield of around 8%. So all things considered, when looking at where they're currently at, the current business quality, their economic mode, the end game catalyst, whether is it going to robotics, trying to replace their delivery network, being able to lock in both the users and merchants, which is the very important two-sided marketplace. That's why I continue to follow this company very closely. So with that in mind, if you enjoyed this kind of breakdowns, please, if you've watched until the end, don't forget to help me smash that cute little like button. And I'll see you guys in the next video. And more importantly, and hopefully, I'll see you guys on the moon. Goodbye.